Friends, welcome back to our channel OMSAI Bhojanapalli.
Good morning, friends. The Sunday's class, we completed dividend policy. We started with the next chapter, portfolio management or portfolio theories. So in that, we completed the risk return calculation for a individual security. We discussed how to calculate return and risk for a portfolio of securities. We'll continue with the first segment, risk return profile, with more number of problems. We'll try to complete that today and also do another area called as Markowitz portfolio theory. Every portfolio theory leads to the next stage. Short comes after Markowitz. Most of the conclusion will be accepted and then proceed with further. So every theory is important. In examination, from all theories, problems will be asked. The main thing with us is we should be able to identify the question. Okay, all tries to find out KE only or the required rate of return, etc. One should be able to identify which should be applied and the problem should be solved. For that, a very logical and conceptual discussion of each and every portfolio theories are very, very important. All theories give some very good conclusions as well as interesting aspects of share valuation can be understood. Now, let us first summarize what is done in this chapter before I proceed further. Please settle down. We saw that value of any asset is the present value of the future benefits from that asset discounted at required rate of return of the valuer. So the required rate of return of the valuer depends on the risk he perceives from the given asset. The discount rate is dependent on risk. Now this chapter tries to address two questions. Number one, how to measure that particular risk. Risk of an asset, how it can be measured. Number two, for a given level of risk, how much return we can expect or we should expect. These are the two issues which the chapter tries to ascertain. And this chapter, as I said, will be discussing in 6 segments. Number one is risk return profile. That is a very simple, small, basic area which we started with. Once we complete that, we will discuss 4 theories: Markowitz portfolio theory, sharp single index model, capital asset pricing model, arbitrage pricing theory. Then we will conclude the chapter with a discussion about efficient market hypothesis. So first we started with the risk return profile. First of all, when I take a security, I have to analyze the security. 2 things I want to know. If I make this investment, what return I can expect from it. I don't say what is already earned, what return I can expect from it. Number 2, how certain is that particular return. So I want to know the expected return and the certainty of the expected return, which we call as risk. Expected return or certainty of the expected return can be found out for a security in 2 ways. I rely on the past data or I do a scenario analysis. One is without probability and second is with probability. Now the first question is, what is the expected return of a security? It is not that I expect extremes, I always expect only average. Mean is always a representative number. So the word expected return means average return or mean return. And the risk is measured by the standard deviation. So here, if I do the expectation without probability, it is called a simple average. If we have probability, we will be having the weighted average. Standard deviation of a security, sigma x, is nothing but square root of sigma x minus x bar, the whole square divided by n. If we have, say, a probability attached scenario analysis, it is sigma x is equal to square root of sigma p into x minus x bar, the whole square. This is the first lesson we have learned in this portfolio theories. Next, we saw how an individual security can have a risk and return. A portfolio of securities too will be having an expected return as well as the risk. What is a portfolio? Portfolio means a group of assets. We call it as portfolio. Now we saw how to calculate the expected return and risk of a portfolio. Number one, expected return of a portfolio is nothing but weighted average return of the individual securities inside that portfolio, where the weights are the proportion of securities in the total portfolio wealth. So here, to put it simply, return of portfolio is equal to W1 return of X plus W2 return of Y, which if found using the table, the security, the proportion, the return, and then weighted return. So a portfolio return depends on two aspects. One is how much return the securities inside the portfolio are given, and number two is in what proportion I am investing in those securities. Next, risk of a portfolio visa is not equal to the weighted average risk of the individual securities, because risk of the portfolio is not influenced by two factors but influenced by three factors. The factors influencing a portfolio risk is number one, the risk of the individual securities. Number two, proportion in which I am investing money in those securities. Number three is the co-movements. Okay. The formula is sigma p, the standard deviation of portfolio, is equal to square root of W1 square sigma x square plus W2 square sigma y square plus 2 into W1 into W2 into sigma x into sigma y into correlation of x and y. Rxy is the formula for the sigma p, or the standard deviation of portfolio. Here we saw the three factors affecting first is the risk of individual securities. If the portfolio consists of highly risky securities, portfolio will be risky. It consists of Government of India bonds, it will be what? No risk or less risky and so on. So the nature of the portfolio risk depends on the risk of the securities constituting the portfolio. Not only the securities risk influences the portfolio risk, the proportion which I invest. Suppose I put more money in a high risky security and less money in a low risk security, the portfolio will be more risky. If I do the opposite, the risk will be reduced. So the risk of individual security and then proportion, two important factors. Individual security risk we represent by sigma x, sigma y in the formula, proportion by W1, W2 in the formula. But the third important factor is what? Co-movements. It is measured by correlation. We all have seen that diversification reduces risk. If I put the entire money in one security, my entire wealth depends on the performance of that security alone. If I put the money in a number of securities, if one doesn't perform, there is another to help me out and in stabilizing my returns. So diversification reduces risk. Even if you have a portfolio with very high risk security, still portfolio can be having what? Low risk by selecting proper securities having negative correlations we have discussed. So correlation coefficient measures the co-movement between the security returns. This correlation can take value from -1 to +1. So we have 5 types of correlation: -1, -1 to 0, 0, 0 to 1 and +1. -1 is called as perfect negative. -1 to 0 is called as negative. 0, no correlation. 0 to +1, positive. And +1 is perfect positive. Now, as a correlation is -1, we'll be having the maximum benefit through diversification. As a correlation negativity reduces, then the risk reduction is also going to reduce. At +1 correlation, we will not be able to reduce the risk through diversification. Now we also saw that when correlation is -1 or +1, the sigma p formula can be simplified. Sigma p is equal to R is equal to +1. Tell me sigma p is equal to W1 sigma x plus W2 sigma y. R is equal to -1. Sigma p is equal to W1 sigma x minus W2 sigma y. And when correlation is -1, I can even reduce my risk to 0 through an optimum proportion. Proportion of x is equal to sigma y by sigma x plus sigma y, and proportion of y is equal to sigma x by sigma x plus sigma y. You also saw the small derivation also. This is what has been discussed in the portfolio theories till now. Everybody, can I proceed or not? Now, we'll do some problems quickly in whatever has been discussed till now, and then we discuss about when the portfolio consists of 3 securities, how the risk will be calculated. Then we'll generalize from n security portfolio, how to calculate the standard deviation, and then move on to the next area called as Markover's theory. Before I move to Markover's, I also have to discuss how the correlation should be calculated. We'll do one formula for, say, one problem for correlation calculation also. Everybody, can we start or not? Now, take question number 4. Now, I require help because question number 4, 5 and 6, you should tell me the answers, because whatever needs to be discussed, last class 2 o'clock to 3 o'clock I discussed, remember or not? Elaborate discussion was made, now it is followed to apply and tell me the answers. Okay, please get in quickly, settle down. Shall I start now? Now, please. Take question number 4. All these problems are past examination questions, just to get a grip on what is being solved, and also feel comfortable that you are able to comfortably answer the questions. If so, can I proceed? Now, Novex owns a portfolio settle down. Novex owns a portfolio of 2 securities with the following expected return, standard deviation and weights. Security X and Y, expected return 12%, 15%, standard deviation 15%, 20%, weight 0.4, 0.6. What are the maximum and minimum portfolio standard deviations for the varying levels of correlation between the 2 securities? If correlation is -1, calculate the proportion of the individual securities in portfolio to reduce the risk to 0. Okay, can we start or not? Now, see. My portfolio consists of how many securities? Name the 2 securities. Okay. What is the return of X? How they would have calculated? Return of X, how they have calculated the average return. It may be simple average or weighted average. Whether they do the past analysis or do the scenario analysis. Next, how the 15% of Y would have been calculated? Same, average return. Now, standard deviation of X is 15%. How they would have calculated 15%? Sigma X is equal to square root of X minus X power the whole square divided by N. How they would have calculated the 20%? Sigma Y is equal to square root of sigma Y minus Y power the whole square divided by N. Had this been done based on scenario analysis where situations are given probabilities, then sigma X would have been what? Square root of sigma P into X minus X power the whole square, and sigma Y is square root of sigma P into Y minus Y bar the whole square. These 2 numbers only we learn how to calculate in the first 2 sums, right or not? And how much I am going to invest here? I am going to put 40% of my money in X and 60% of the money in Y. Now, let's answer the question one by one. What are the maximum and minimum portfolio standard deviations for varying levels of correlation between the 2 securities? Now, the maximum standard deviation means maximum risk arises when the correlation is +1. So we have to find out sigma P, assuming first the correlation to be +1. The minimum standard deviation arises when the correlation is what? -1. So we have to calculate sigma P by assuming the correlation to be -1. That's the first part of the question. Right or not? Next. When correlation is -1, can I reduce the risk to 0 or not? Yes. How to reduce the risk to 0? By investing in proper proportion. Thus 40, 60 may not give, but some proportion may give the risk as 0 by investing in proper proportion of x and then y. What is proportion of x? Sigma y by sigma x plus sigma y. What is proportion of y? Sigma x by sigma x plus sigma y. That's a question which is being asked. Everybody following or not? Now, they did not ask you to find out the portfolio return. Still, I will find out just for some interpretation. That's all. This is the examination problem. Tell me, difficult or simple? Okay, can we start or not? Let us start with the solution. Write down question number 4. We'll do it together. Please settle down. Question number 4. Portfolio return. Step 1, portfolio return. The question did not ask you to calculate portfolio return. I am just calculating it, that's all. Okay, portfolio return. Portfolio return. Can you start or not? Tell me the columns. Security, proportion, return, weighted return. Security, proportion, return, and then weighted return. Okay, tell me the two securities constituting the portfolio, X and Y. X and Y. How much percentage of the money is invested in X? 0.4. Y, how much proportion? 0.6. What is standard? What is the return of X? 12%. Return of Y is 15%. 40% of my money is earning 12%. 60% of my wealth is earning 15%. What weighted return? 0.4 into 12, 4.8. 0.6 into 15, 9. The total is 13.8%. Total is 13.8%. If I invest in Y fully, I could have earned 15. Had I invested in X fully, I could have earned. But by investing in both in some proportion, the weighted average return I am earning is 13.8%. Can I proceed or not? Next. Step 2. Maximum portfolio risk. Step 2. Maximum portfolio risk. That's one of the question now. Maximum portfolio risk. Underline that. Write down. Maximum portfolio risk occurs. Maximum portfolio risk occurs when correlation is +1. Maximum portfolio risk occurs when correlation is +1. Maximum portfolio risk occurs when correlation is +1. Continue. When correlation is +1, sigma p is equal to, when correlation is +1, sigma p is equal to, formula please, sigma p is equal to what? W1 sigma x plus W2 sigma y. Sigma p is equal to W1 sigma x plus W2 sigma y plus W2 sigma y. Can I proceed? Now, sigma p is equal to, tell me the substitution here, 0.4 into 1.5, 0.4 into 15, 0.4 is W1, 15 is sigma x, plus what? 0.6 into 20. 0.4 into 15 plus 0.6 into 20 is equal to how much? 18%. Sigma p is equal to 18%. So when the correlation is +1, the risk is 18%. Next. Step 2 or step 3? Step 3. Minimum portfolio risk. Step 3. Minimum portfolio risk. Minimum portfolio risk. Unlike that. Minimum portfolio risk occurs. Minimum portfolio risk occurs when correlation is -1. Minimum portfolio risk occurs when correlation is -1. When correlation is -1. When correlation is -1, Then correlation is minus 1. Sigma P is equal to, when correlation is minus 1, sigma P is equal to W1 sigma X minus W2 sigma Y. Sigma P is equal to W1 sigma X minus W2 sigma Y. Substitute numbers, what into what? 0.4 into 15 minus, please tell me 0.4 into 15 minus 0.6 into 20. 0.4 into 15 minus 0.6 into 20. What is the number here? Okay, don't say it as minus 6. Write as what? 6%. Standard deviations cannot be negative. That is, it is absolute number only. We just netting of two numbers, that's all. Make it as an absolute number. It is because variation is always what? Positive and negative. It deviates 6% above or below the mean. That's the meaning. Are you following not? So we cannot have as minus 6%. Minus 6% also is going to be what? Same 6% only here. Everybody following not? So don't write as negative. Write as what? 6%. Everybody, can I proceed or not? No. So now we have found out the maximum portfolio risk and then what? Minimum portfolio risk. When the portfolio is what? 0.4, 0.6. Respond. Yes or no? No. At some proportion, at some portfolio proportion, can you reduce risk to 0 or not? That's the second question. If correlation is minus 1, calculate the proportion of the individual securities in the portfolio to reduce the risk to 0. That's a question. Can I proceed or not? Write down step 2 or step 3? Step 3. Okay, step 4. Sorry, step 4. Optimum portfolio proportion. Optimum portfolio proportion. Optimum portfolio proportion. In bracket, this can also be given another name, minimum variance portfolio. Standard deviation, variance, both are same, only the square root taken, that's all. It is also called as what? Minimum variance portfolio. Optimum portfolio proportion or minimum variance portfolio. Optimum portfolio proportion or minimum variance portfolio. Write down. When correlation is minus 1, when R is equal to minus 1, when correlation is minus 1, through a specific mix of X and Y, when correlation is minus 1, through a specific mix of X and Y, through a specific mix of X and Y, the risk can even be reduced to, through a specific mix of X and Y, the risk can even be reduced to, the risk can even be reduced to 0. The risk can even be reduced to 0. Proportion of X is equal to, proportion of X is equal to, substitute the number, proportion of X is equal, first tell me the formula, sigma Y divided by sigma X plus sigma Y. Proportion of X is equal to sigma Y divided by sigma X plus sigma Y. Can we substitute? Now tell me, what is sigma Y, standard deviation of Y, please? 20 divided by 15 plus 20. 20 divided by 15 plus 20. Tell me the proportion. What is the proportion? 50.57. Getting around 0.57 or not? 57%. 0.57 or 57%. I just rounded off to 2 decimals. Better even to have 3 or 4, not an issue. Can I proceed? Next. Proportion of Y is equal to sigma X by sigma X plus sigma Y. Proportion of Y is equal to sigma X by sigma X plus sigma Y, which is equal to, what is sigma X? 15 divided by 15 plus 20. 15 divided by 15 plus 20 is equal to 43%. Is equal to 43%. Is equal to 43%. Tell me, if I invest in X 57%, Y 43%, then the risk is what? 0. For this proportion, can we calculate a portfolio return or not? Write down. Next. Step 3 or step 4 or step 5 or step 5. This is not asked, we'll do it. Okay, step 5. Portfolio return. Step 5. Portfolio return. Step 5. Portfolio return. Let's do it together. Tell me what are all the columns here? Securities. First column is securities. Second column, proportion. Third column, the return. Fourth column, weighted return. Return and then weighted return. Now, can we start up? What are two securities in the portfolio? X and then Y. Securities are X and Y. What is the proportion of X? 0.57 and 0.57. At 4 is the old question. Yeah. Now, I found out a proportion make risk 0 or not. So, X is what? 0.57. Good morning, friends. Good morning. Y is what? 0.43. Y is 0.43. Just now we calculated not. Now, tell me what is return of X? How much percentage here? 12%. Return of Y? 15%. 0.57 into 12. Somebody tell me the number. 6.84. And 0.43 into 15. How many days? 6.84, 6.45. Tell me the total. 13.29%. We call as RP. RP means what? Return of portfolio. 13.29%. 13.29%. Now, 13.29% is having how much risk? This return is certain or not? Yes. We can even call this as risk-free return. Everybody, are you following what I am saying? It is as good as investing in what? Government security. Later, these things will be disputed during CAPM, etc. But at present, at this juncture, up to Markowitz, this return can be called as what? Risk-free return, because for this return, the standard deviation is 0, provided the correlation between X and Y is -1. Everybody following on? Write down. Next. The above portfolio return of 13.29%, the above portfolio return of 13.29% could be considered as, the above portfolio return of 13.29% could be considered as what return? Risk-free return. Could be considered as risk-free return because for this return the standard deviation is 0. Because for this return the standard deviation is 0. For this return the standard deviation is 0. Everybody, are you comfortable or not with this? We have completed question number 4. Please take the next question, question number 5. Again a past examination problem. L limited and M limited has following risk return estimates. RL, return of L 20%, return of M 22%, standard deviation of L 18%, standard deviation of M 15%, correlation coefficient, that is RLM, correlation between L and M is -1. That means perfect negative. Calculate the proportion of investment in L and M to minimize the risk to 0 or to minimize the portfolio risk. Can we start or not? Very simple. Let's do it together. First write down. Okay, write down. First, step 1. Step 1. Calculation of the portfolio proportion. Calculation of portfolio proportion to reduce the risk to 0. Calculation of the portfolio proportion to reduce the risk to 0. Calculation of portfolio proportion to reduce the risk to 0. Can we start or not? Now, write down. Proportion of L is equal to, please tell the formula, proportion of L is equal to what? Sigma M by sigma L plus sigma M. Sigma M by sigma L plus sigma M. Standard deviation of m by standard deviation of L plus standard deviation of m. Please tell me the substitution. What divided by what? Question has given you know. What is that? 15 divided by 18 plus 15. 15 divided by 18 plus 15. Okay. What is the number you are going to get? 45.45%. Have it as 45.45%. 45.45%. Shall I proceed? Next. Proportion of m is equal to. Proportion of m is equal to substitute number sigma L by sigma L plus sigma m. Proportion of m is equal to sigma L by sigma L plus sigma m. Which is equal to, tell me the number, it is 18 divided by 18 plus 15. That's the wrong typing. 18 by 18 plus 15. You can change it. Tell me what's the number? 54.55%. Number is 54.55%. Why are you saying good morning to me now? Tell me the reason. I only corrected by being alert, right or not? Now, continue. Step 2. Portfolio written at the above proportion. Portfolio written at the above proportion. Portfolio written at the above proportion. So tell me what are all the columns? Security, proportion, return, weighted return. Security, proportion, return and weighted return. What are two securities? L, M. L and then M. What are the proportion of L and M? Tell me the number. 0.4545. 45.45% or not? 0.4545. 0.5455. 0.5455. Look at the question. Tell me what is the return of L and M? 20, 22. Return is 20 and 22. The weighted return is 9.09, 12. 9.09 and then 12. 9.09 and 12. What is the total weighted return? It is 21.09. 21.09. The above return is what return? Risk-free return. The above return is risk-free return. The above return is risk-free return. Is risk-free return. Everybody, are you comfortable or not? With this, we have completed question number 4 and question number 5. Take the next question, question number 6. And pause examination problem, please. European Limited has been specially formed to undertake two investment opportunities. The risk and return characteristics of the two projects are shown below. Expected return, project A 12%, project B 20%, risk 3% and 7%. European plans to invest 80% of its available fund in project A and 20% in project B. Directors believe that the correlation coefficient between the returns of the project is plus 0.1. Required, calculate the returns from the proposed portfolio of projects A and B. Calculate the risk of the portfolio. Comment on your calculation in part B in the context of risk reducing effect of diversification. Suppose the correlation coefficient between A and B was -1. How should European Limited invest its fund in order to obtain a zero risk portfolio? This is all the question which has been asked. Again I say, all this question will be very simple. if you understood the introduction properly, can I say this is the examination level generally. This question will find it difficult to understand if you don't understand the basic risk return profile. Otherwise, these are all very, very simple questions. Okay, now, before I start with the solution, I just want to share one or two issues here and then start with the problem. Okay, see, when I say portfolio, I say it is investment in more than one security. Yes or no? Yes, I own an Axis Bank share, I own a TCS share, I am holding what? Portfolio of shares. Respond, yes or no? Now, portfolio is also nothing but the group of assets. We call it as what? Group of assets. I can say like this, a company itself is a portfolio, right or not? A company itself is what? Portfolio. A company is nothing but portfolio of projects. A company is nothing but what? Portfolio of projects. For example, very highly diversified group is Tata Group, right or not? So the Tata Group is having what? Portfolio of projects where they have lot of what I say ancillary companies. Right or not? They are in software, they are in what? Salt manufacture, they are in what? Steel, they are in what? Automobiles. So anywhere we go, they are in what? Jewelry business. So anywhere we go, they have what? A business there, no? That is why we call that company to be less risky, right or not? Because it's a well diversified company. Are you following not? So a company is nothing but what? Portfolio of projects. What concepts I apply here for two securities, I even apply for what? Two projects. Everybody follow what I am saying? How two securities in my portfolio is going to reduce my risk. We are having same way. If I have two projects which are having what? Different businesses, can even reduce my what? Risk, provided they have a negative correlation or a correlation not equal to +1. Everybody, are you following or not? Now, so here, there are two projects this company is planning to do. What are two projects? A and B. Expect the return of A is 12% and B is what? 20%. How they would have calculated it? Not at all. They would have calculated IRR. For a project, what are the expected of a project? You forecast a project cash flows. Yeah, I invest today 20 crore rupees in a project. First year, so much inflow. You do the projections or not? Project don't go for the past year. Project is not traded in stock market. You know, right or not? So when I say expected return, I mean here what? IRR. I mean what? IRR. I forecast cash flow in 2 or 3 ways and calculate what? The average IRR, which I call as expected return. Respond yes or no. The risk of the project is a standard deviation of the project. How to calculate standard deviation of a project, we'll discuss a separate class, a full 3-hour class. We'll discuss about calculation of standard deviation of project in an area called as Hiller's model later in capital budgeting under uncertainty. At that time, I'll come back to portfolio once again. Okay, they would have calculated using the Hiller model the standard deviation of the project as 3% and then what? 7%. But these two numbers can be calculated. About these two calculations itself be having what? A separate class later once I complete the portfolio chapter. Everybody following or not? Now. So there are two projects. Project A gives a return of 12%, has risk of what? 3%. And B gives a return of 20%, has risk of how much percent? 7%. What just an observation. What the advantage of project A? Is a low risk project. What the advantage of project B? Is a high return project. Respond. Are you following or not? Now, I want to do both together. I want to do both together. In which I invest my money or not. How much I invest? 80% of my money is invested in A and 20% in B. And A and B is having a correlation or not. The correlation is what? Plus 0.1. Is it perfect positive? It's only positive. It is only plus 0.1. Understood? Now they ask you to find out the remaining. All these are simple, straightforward questions. Can we start doing it together or not? Now let's start answering the question one by one. Write down. Part A. Let's do the answer one by one. Part A. During this discussion, I want to have the conclusion in that discussion. What we discuss extra? Company is what? Portfolio projects. How a security can have a risk and return. A project also can have what? Risk and return. Return of a project is IRR. Risk of a project is a standard deviation. How to calculate the standard deviation of project cash flows is a separate issue which we will discuss in what? Hiller's model later. Can I proceed? Now. Calculate the Return from the proposed portfolio. Can you start or not? Now, write down part A, portfolio return. Part A, portfolio return. Part A, portfolio return. All again simple, straightforward calculation. Can I proceed? Tell me what are the columns? So, sorry, make it as what? Projects. Make it as projects. Proportion, return, weighted return. Project, proportion, return and weighted return. The two projects are A, B. The projects are A and then B. What is the proportion invested in A and B? 0.8, 0.2. Proportion is 0.8, 0.2. The expected return from project A is how much here? 12% and 20%. 12 and then 20. 0.8 into 12, 9.6. 0.2 into 24. The return of the portfolio is how much here? 13.6. The expected return is 13.6. This portfolio of projects is expected to give me a return of 13.6%. Can we proceed to the next stage? Next. Part B. Risk of the portfolio. Part B. Portfolio risk. Risk is measured by what? Standard deviation. Also calculate sigma P. Risk of the portfolio. Risk of the portfolio. Okay. Can you start or not? Tell me. What formula to be used for calculate risk of the portfolio? Small or big formula? Big formula. Because the correlation is not -1 or +1 to make it weighted average. It is having what? Some number. So I have to go for the original formula. What is the formula? W1 square sigma A square plus W2 square sigma B square plus 2 into W1 into W2 into sigma A into sigma B into correlation of A and B. Respond yes or no. Substitute the numbers. Sigma P is equal to, write the formula first. Sigma P is equal to square root of W1 square sigma A square, square root of W1 square sigma A square plus W2 square sigma B square plus 2W1 W2 sigma A sigma B correlation of A and B. W1 square sigma A square plus W2 square sigma B square plus 2W1 W2 sigma A sigma B correlation of A and B. Substitute the numbers, which is equal to square root of 0.8 squared into 3 squared, and a proportion of A is 0.8, no, 0.8 squared into 3 squared plus 0.2 squared into 7 squared plus 0.2 squared into 7 squared plus 2 into 0.8 into 0.2 into 3 into 7 into 0.1. What is the 0.1? Correlation into 0.1. Finish writing or not? Believe me, the answer is 2.9%. The answer is 2.9%. The standard deviation of the portfolio is 2.9%. 2.9%. Everybody, can I proceed or not? No. If you see the beauty of diversification, project A is having a risk of 3%. Yes, project B is having a risk of what? 7%. A and B together has a risk lower than the individual security risk. That's the beauty of what? Diversification. The chapter itself is made very interesting. Only due to what? This diversification. Just now we started here. They'll play with this particular concept in so many ways to understand KE. Are you following what I'm saying? So the diversification is so great that by having a portfolio, even I can get a return, means having a less say risk less than what? The risk of the individual security itself. Are you following what I'm saying? Even if I invest 100% money in what? Security A, still my risk is what? 3%. The beauty is the portfolio is more efficient because the portfolio gives how much return? 13.6% return. For how much percent risk here? 2.9, which I cannot get from project A alone. Yes or no? Now project A gives a lower return for what? Higher risk. But the portfolio of B along with what? B is better than A. Are you following what I am saying? This is the advantage of what? The diversification. More Markowitz will explain. Are you following or not? So with this we complete the part B of the question. Can I proceed or not? Now write down observation. Observation. observation, it could be seen that due to diversification, the portfolio risk, is even lower than the risk of the individual securities. The portfolio risk is even lower than the risk of individual securities. The portfolio risk is even lower than the risk of individual securities. In fact, this portfolio is superior to project A. Because, you can tell me the reason why it is superior? Because it gives what? Higher return. Because it gives higher return for a lower risk. Okay. Part B over. Can I go to part C or not? No. See part C of this question. Comment on your calculations in part B in the context of risk reducing effect of diversification. This we have to answer what I dictated earlier. Last class I did or not? I can dictate once again, yes or no, because a portfolio risk depends on three factors. The third factor is what? Co-movements. Then tell them about the correlation, the type, how the positive correlation can reduce the risk. About that one should be understanding. Respond, are you following or not? Now the part C question I cannot dictate, is already dictated, right or not? I leave it. Next, part 4. Suppose correlation coefficient between A and B was -1. Now they change the question. Earlier it was plus 0.1. No, they suppose becomes what? -1. How should European Limited invest in funds in order to obtain the zero risk portfolio? How to invest a fund to have a zero risk portfolio? Proportion of A is equal to sigma B by sigma A plus sigma B, and proportion of B is equal to sigma A by sigma A plus sigma B. Respond, yes or no? Write down part D. Part C answer, I given us homework. Now part D. I am awake. Okay, part D. Don't assume I am always sleeping. Okay, part D. RTM portfolio proportion. Optimum portfolio proportion. Proportion of A is equal to sigma B by sigma A plus sigma B. Sigma B by sigma A plus sigma B, which is equal to 7 divided by 3 plus 7. 0.7 or 70%. Proportion of B is equal to sigma A by sigma A plus sigma B. Sigma A by sigma A plus sigma B, which is equal to 3 by 3 plus 7, is equal to 30%. Okay. With this we have completed solution to question number 6. So 1 to 6 has been solved. All the 6 problems are about the basics in portfolio, namely the risk return profile. From this itself, lot of examination questions are being asked, but every question I need not do, all are repetitions only. That's all to learn in what? Basics in this risk return profile. Can I proceed further or not? No. Before I move on to Markowitz, I want to discuss 2 more issues and then go for the Markowitz theory. Don't talk, please. One is how to calculate correlation coefficient. Okay, they are given you here. Sometimes they may ask you to calculate what? Correlation. The correlation calculation also very important for beta calculation later. Is very important for sharp single index model calculation and so on. So now we have to necessarily know how to calculate the correlation. There are lot of formulas for correlation calculation. Call Pearson's correlation coefficient is there and so on. We'll go for a simple formula, easily understandable one in all situations to calculate the correlation coefficient. Can I proceed or not? And regression also will be covered. I'll cover the regression during the sharp single index model later. Can I proceed or not? Now, give the heading correlation coefficient. Give the heading correlation coefficient. Okay, write down Rxy is equal to, Rxy means what? Correlation between x and y. Always two items, you have to see the correlation, no? Correlation between x and y is equal to, Rxy is equal to covariance of x and y, covariance of x and y divided by sigma x into sigma y. Covariance of x and y divided by sigma x into sigma y. In the nadu number into pi, it is another x. Okay, it is sigma x into sigma y. I think I understand or not? I will change later as asterisk sigma x into sigma y. Can I proceed? Now. So, now to calculate correlation, one should know how to calculate covariance or not? Write down. Covariance of x and y. Covariance of x and y, continue writing, covariance of x and y can be calculated as follows. Covariance of x and y can be calculated as follows. Branch it into 2. Covariance of x and y can be calculated as follows. Branch it into 2. First branch. When there is no probability, question number 1 we discussed na same way. First branch, when there is no probability. Second branch, when there is probability. First branch, when there is no probability. Second branch, when there is probability. How we know calculation of standard deviation without probability, with probability, yes or no? Like that covariance also without probability, with probability. Can I proceed? No. Without probability, right? Put a down arrow mark and write covariance x and y is equal to, covariance x and y is equal to sigma x minus x bar into y minus y bar, sigma x minus x bar into y minus y bar divided by n. Covariance of x and y is equal to sigma x minus x bar into y minus y bar divided by n. Second branch, with probability, put a down and write covariance of x and y is equal to, covariance of x and y is equal to, can you guess the formula? Sigma p into x minus x bar into y minus y bar. So in the slide, I just put a hyphen for x bar and y bar. You should put what? Dash above the x and y. Can I proceed? So it is covariance of x and y is equal to sigma p into x minus x bar into y minus y bar. Sigma p into x minus x bar into y minus y bar. This is the covariance of x and y calculation. Can I proceed or not? No. Okay. Before I proceed, tell me correlation. How to calculate correlation? Correlation between x and y is equal to what? Covariance of x and y divided by sigma x into sigma y. How to calculate covariance? It depends on whether the data is given with probability, data is given without probability. Without probability data given means what is covariance of x and y? Sigma x minus x bar into y minus y bar divided by n. With probability is what? Sigma p into x minus x bar into y minus y bar. Everybody, can I proceed or not? Now, let us take one problem as example. Question number 1, let us take and see how to calculate correlation between x and y. Okay, see. If you see question 1, stop talking. 2 shares are there in the stock market. In the first year, security X reported how much return? 6.6. Security Y 24.5. In the second year, X reported 5.6. Y reported minus 5.9. Third year, X reported minus 9. Y reported 19.9. Like that, different years, the stocks have reported different profits, which you can get from the stock market data. Can I put it or not? No. I want to know how the returns of the two securities go together. That's what we call as what? Correlation. When X increases, Y also increases. When X decreases, Y also decreases. If this is happening, the correlation is what? Positive. When X increases, Y also always increases. X decreases, Y also what? Always decreases. They are the constant rate. It is called as what? Perfect positive. Then I can say for negative. But the correlation can be of different strength or not. In this case, can you tell me correlation will not be perfect? Yes or no? Because first year 6.6, 24.5. Keep it as a base. X decreases. Y also what? Decreases. But decrease is what? Very much than X. X decreases. Y what? Increases. And then yet from here what? Increases. And Y what? Decreases. And X 12.6 to 14 becomes what? Increasing. And Y also increases. There is some correlation, but not what? Perfect. We have to see whether how they are correlated, how these two data move together. One should be understanding and not how they vary together. X also varies, Y also varies. X also varies, Y also varies. And the individual variation is called as standard deviation. So now, how X and Y varies together, what is strength of their co-movement, we call it as what? Correlation. Above that only I are going to calculate now. Respond, yes or no? Now, tell me to calculate correlation. The first step I have to calculate what? Covariance. Can we do the sum together or not? Write down. Let us calculate correlation. Write down. Let us calculate correlation for question number 1. Let us calculate correlation for question number 1. Let us calculate correlation for question number 1. For question number 1. Can you start or not? Now, in that step 1, calculation of covariance of X and Y. Step 1, calculation of covariance of X and Y. Calculation of covariance of X and Y. Can you start or not? Tell me the following columns. First column is year 1, 2, 3, 4, 5. Please do along with me. First column year 1, 2, 3, 4 and then 5. Next is X. We have to tell the return of the security X. Now past 5 years, how X has performed. Tell me the returns X has generated here. 6.6, 5.6, minus 9, 12.6, 14. I hope you are writing along with me or not. 6.6, 5.6, minus 9, 12.6 and 14. Tell me the behavior of security Y return. 24.5, minus 5.9, 19.9, minus 7.8, 14.8. 24.5, minus 5.9, 19.9, minus 7.8, 14.8. Can I proceed or not? No. I have to find out what? X minus X bar, Y minus Y bar, and then multiply sigma X minus X bar into what? Y minus Y bar. Respond yes or no? No. X minus X bar. We already have it in the first problem. Yes or no? We can just take the number straight away. I think X bar is 5.96. Enna parida? No. You can look at the first question. No need to calculate once again. Look at that and tell me what is X minus X bar you calculated here. 0.64. Look at that and write. Don't look at the slide and tell me that I have already put. Yes or no? Look at the notebook and tell me for second year what is X minus X bar? Minus 0.36. Only few are answering. Yeah, everybody, what happened to your voice? Please tell me. Okay, third, what is X minus X bar? Minus 14.96. Fourth, what is X minus X bar? 6.64. 5, what is X minus X bar? 8.04. Now, I am asking answer not because I wanted, I already have it here. To know whether I understood or not, where you are taking from the numbers. Can I say? No. Can you just tell me quickly, x minus x bar, the total should be what? Why it should be 0? Deviation from mean always will be what? 0. Then only the number can be called as mean itself. Are you following or not? Next. Y minus y bar. We had calculated now. Please tell me the numbers from the same problem. Question number 1. 15.4 minus 15. 10.8 minus 16.9. 5.7. 15.4 minus 15, 10.8 minus 16.9, 5.7. Can you guess what is that the next column I'm going to have? X minus x bar into y minus y bar. Here sign are very important because when I square it, sign will vanish. When I multiply two numbers, sign will what? Persist. The sign only shows positive and negative correlation. Are you following or not? Now, tell me 0.64 into 15.4 gives you how much here? 9.856. Minus 0.36 into minus 15 will become plus or minus a plus. Become how much it is? 5.400. 5.400. Minus 14.96 into 10.8 is equal to minus 161.568. Minus 161.568. Minus 161.568. 6.64 into minus 16.9. I want a number. Minus 112.216. Minus 112.216. 8.04 into 5.7 is going to give me 45.828. Is equal to 45.828. If I total, tell me what the total number I am going to get? The number sign is important. Minus 212.7. That is minus 212.7. I want you to answer what is this minus 212.7? Sigma x minus x bar into y minus y bar. Respond yes or no, right? Next, continue. Covariance of x and y is equal to sigma x minus x bar into y minus y bar divided by n. Covariance of x and y is equal to sigma x minus x bar into y minus y bar divided by n. Which is equal to, tell me what is sigma x minus x bar into y minus y, calculate just now, minus 212.7 divided by 5. Minus 212.7 divided by 5. Can you tell me the number here? Minus 42.54. Minus 42.54. Minus 42.54. This is called as what? Covariance of x and y. Can I proceed? Next. Step 1 or step 2? Step 2. Correlation of x and y. Step 2, correlation of x and y. Correlation of x and y. Correlation of x and y. Underline that. Rxy is equal to, I forgot the formula, please tell me, R is equal to what? Covariance of x and y divided by sigma x into sigma y. We need not calculate sigma x, sigma y, already calculated in first sum, yes or no? You look at the number and tell me, okay, it is covariance of x and y divided by sigma x into sigma y. Please tell me the substitution, minus 42.54 divided by, minus 42.54 divided by what? 8.16 into 13.39, which we calculated in the first sum. Don't ask me where it is given. We have calculated in the first class. Yes or no? So minus 42.54 divided by 8.16 into 13.39. Can you just tell me the simplified number is going to be how much here? Minus 0.39. The answer is minus 0.39. Minus 0.39. Okay. My question is, when x increases, y decreases. Stop writing. Have you finished calculating or not? Now, listen to my words, then you comment on my conclusion. When x increases, y decreases. Is what negative correlation indicates. True or false? Yes, it is what? True. When x increases, y decreases. The correlation is negative correlation. Right or not? Next. When x increases by 1%, y decreases by 0.39%. When x decreases by 1%, y increases by 0.39%. True or false? Correlation never tells you the slope. It never tells you what the slope. For finding out the slope between x and y, have to go for regression, which will do in sharp single length model later. Or in what I'm saying, when you do regression only, correlation itself can be understood what? Much more in detail. I'll give you the full explanation of what? Regression and correlation, including error coefficient in what? The sharp single length model later. But understand that correlation will not tell you at what rate x and y is moving. That slope can be found out only through what? Regression. Only thing what the 0.3 indicates is the strength of the correlation only 39%. The strength is only what? 39%. It is not always true that when x increases, y decreases. The correlation is very scattered. The correlation is what? The points are very scattered. Where the strength of co-movement is only what? 0.39. The strength of one is what? Very strong. Where the relationship is always true, they form a straight line. Yes or no? And when the points are fitting into a straight line, the points are what? Fitting into a straight line, then the strength is what? Highest. Never they move away from the slope. Or you'll find what I'm saying. In that case, the correlation is +1 or -1, depending on whether line is this way or this way. Or you'll find not. And when the points begins to scatter, when the points begin to what? Scatter, more scatter the points, then the slope is more untrue. Because the points are more scattered. If the points are nearer, we can see the slope correctly. So no, the points are what? Scattered and scattered and scattered. The slope is what? Unsure. The correlation is what? Weak. It only indicates that the correlation is weak. It is not saying it moves by what? 0.34. Never correlation tells you the slope between x and y. It only tells you how the points are scattered. Are they closely scattered or widely scattered? So the correlation is 0.39, means it's a weak correlation between what? X and y. Respond. Are you following what I am saying? That's the meaning of a correlation coefficient. Can I proceed further? Now. So with this we have calculated the correlation between what? X and y using the formula covariance of x and y divided by sigma x into sigma y. Everybody, did you understand the calculation of correlation coefficient or not? No. Just to simply understand the formula, nothing deeply, let's see how this formula generally works. Okay, now see, my question is correlation of x with x is what? Correlation of x with x is what? It should be 1. +1. Correct? Now instead of writing x and y here, I write what? X and x. Okay, it is going to be what? X and x. Correlation of x with x is what? 1. When x moves up, say higher, x moves once again what? Higher. When x goes back, x also goes what? Back. You don't understand. What is the correlation of myself and my shadow? Yeah? Myself, I and my shadow, what the correlation? Don't say sun, light, angle and all is going to change. Normal shadow, okay, simple. What is correlation of Rajagopal with shadow of Rajagopal? Tell me. When you go forward, it also comes. I cannot say stay, I will alone go. I cannot say, because when I go forward, it also what? Comes. When I run backwards, it also comes. Yes or no? Now. Correct? Now. Correlation of a man and his pet also positive. When he goes, the pet also what? Follows. Comes back, pet also comes back. But not perfect positive, because sometimes if you give some food, it will be staying. Right or not? No. But not, I can say for my shadow. Right or not? No. Correlation of me and my shadow is what? +1. When I move, it also moves. When I go back, it also what? Go back. The rate of movement, speed of movement, everything is what? Perfect. Perfect positive. Are you following not? Now. Correlation of x with x is what? +1. That understood or not? Very simple, yeah? Same. That is nothing but x minus x bar into x minus x bar. Correct? Instead of y minus we have what? X minus x bar. X minus x bar into x minus x bar is going to be the calculation. That becomes what? X minus x bar the whole square. Now, tell me what is covariance? There is nothing but x minus x bar the whole square divided by n. Ennappa, right? Covariance x minus x bar divided by a whole square divided by n. What is x minus x bar the whole square divided by n? Sigma x whole square. Right or not? See, correlation of x and x is nothing but covariance of x and x divided by sigma x into sigma x. What? Sorry. Yes. Correlation of x and x is equal to covariance of x and x divided by what? Sigma x into sigma x. Is accepted? Yes, now, let us calculate covariance of x and x is equal to what? Sigma x minus x bar into x minus x bar divided by n. This you are accepting it or not? Now, next. Covariance of x and x is equal to sigma x minus x bar the whole square divided by n. We all know that standard deviation of x is square root of sigma x minus x bar the whole square divided by n. Yes or no? So this is nothing but what? Standard deviation of the x square is nothing but what? Sigma x the whole square. Sigma x the whole square. Ennappa, right or not? Now I can say correlation of x and x is equal to what is covariance of x and x? Sigma x the whole square divided by sigma x into sigma x. This and this gets what? Cancel is equal to what? Plus 1. Plus what? Yes or no? If the movement of x and y is same way, they move in what? The same way. In the case the correlation is what? Plus 1. The simple proof is x moves with x is what? Plus 1, which I proved or not? Now, why the correlation is not plus 1? Because the x minus x bar and y minus y bar are what? Different. Since they vary differently, the co-movement is also what? Different. Everybody, yes or no? Now, very simple. X with x is variance. X with x is what? Variance. X with y is covariance. X with x is what? Variance. X with y is what? Covariance. So, the numerator is how they vary together. Numerator is what? How they vary individually. Together variance divided by what? Individual variance is going to give me what? The correlation, the strength of their co-movement. Everybody, are you all follow what I am saying? This we call as a correlation coefficient calculation. Very simple. Covariance says how x and y move together, and denominator says what? How they have the individual volatility. Co-volatility divided by what? Individual volatility gives the strength of the co-movement. Everybody, are you follow what I am saying? This is what we call as a correlation coefficient calculation. Please tell me, respond, are you following or not? No. Whether you understand this or not, not an issue. Tell me, correlation of x and y is equal to formula. Covariance of x and y divided by sigma x into sigma y. What is covariance of x and y? Sigma x minus x bar into y minus y bar divided by n. When you have probability, sigma p into x minus x bar into y minus y bar. Respond, are you following or not? No. See. For question number 2, we cannot take covariance, we cannot calculate covariance. I say don't try this problem for say the correlation. Question number 2, I cannot find out correlation between what? X and y, because the x and y are not same question, two different questions. I'll tell you the reason. See, the 1, 2, 3, 4, 5, 6 situations given or 5 situations given or not? In which this probability and this probability are not same. They are what? Different. Okay. Now, always I give probability for a scenario. Yes or no? Now, in scenario 1, x will earn 10, y will earn what? 18. In scenario 2, x will earn what? 20 and y will earn what? 12. The probability is not for the return, is for the scenario that is giving me the return. Return order, in that case, the probability should be same for x and y. Are you understanding the question or not? Now, so this problem is not fit to calculate correlation because this x is a different problem and this y is not different problem. This is a return series for a different scenario and the return given for what? Yet another different scenario. So between these two, I will not be able to calculate the correlation. So with probability, I am not doing any correlation calculation now, but we will do one problem like that when you calculate beta later, when you have numbers with probability. At present, don't go home and try and say, sir, how to calculate correlation. I can never calculate correlation between what? X and y. For question number 2, because the probabilities are what? Different. So P into x minus, that is x x minus x bar can be found out, y minus y bar can be found out. So no, when I say P is a 0.2 or 0.25, a question will arise. Are you follow what I am saying? In that case, second question is not a fit problem to calculate what correlation, because x is a different question and y is what a different question. But in two questions, I cannot find the same answer. Are you follow what I am saying? So leave the question number 2. We only found out standard deviation. That's an introduction problem. I have found out for question number 1 correlation. If you want me to do a correlation with probability for some other question, I'll do it later when I do the CAPM. Everybody, are you following or not? Now, with this we complete this discussion on what? Correlation coefficient. Can I proceed further up? Now, 1 or 2 observations and then we can move on to the Markowitz. Okay, see. Sigma P is equal to, now tell me what is standardization of portfolio formula? W1 square sigma x square W2 square sigma y square plus 2 into W1 into W2 into yes or no? About the square root. Right or not? Now, some books rightly write as follows. I can say like this: sigma P is equal to W1 square sigma x square plus what? W2 square sigma y square plus 2 into W1 into W2 into sigma x into sigma y into what is correlation of x and y? Covariance of x and y divided by sigma x into sigma y. Yes or no? Now, this can be cancelled. This can be what? Cancelled. I can just put what? Square root. I'll get the number as sigma P is equal to, tell me the formula, W1 square sigma x square plus W square sigma y square plus 2 into W1 into W2 into covariance of x and y. Suppose the problem does not give you correlation coefficient, they give you correlation between two sectors given. Now don't think how to apply the formula here. The other formula also exists where instead of correlation express what? Covariance of x and y, where sigma x sigma y gets what? Cancelled. So this is another formula for calculating what? The standard deviation of a portfolio. Respond. Are you following or not? So now tell me, we know two formulas for portfolio, both are same only. It depends on the data given in the question. Tell me the first formula is what? W1 square sigma x square plus W2 square sigma y square plus 2 W1 W2 sigma x sigma y correlation of x and y. The other formula is what? W1 square sigma x square plus W2 square sigma y square plus 2 W1 W2 covariance of x and y. Simply, we don't have sigma x and sigma y because they get cancelled in what? The correlation calculation. Just put as covariance of x and y is yet another formula, say, for calculation of standard deviation of portfolio. Everybody, are you following or not? Now, for these and all, I don't need to do problems. I'll give it as notes. I want to discuss 2 more points and then give you the notes. With that, we'll complete the basic risk return profile. Can I proceed or not? Now, this is point number 1. I wanted to discuss the alternative formula for what? Calculation of the portfolio standard deviation. Can I proceed to the next point or not? Next. Now, I should invest only in 2 shares. I can invest in 3 shares also or not? So now the question is, sir, how to find out risk of a 3 security portfolio? Return of a 3 security portfolio, nothing great. Yeah, we have security X, Y, Z. Then proportion 0.2, 0.3, 0.5. Then return 12, 13, 14. Then find out what? Weighted return, add it. That is not a great issue. Return is simply weighted average return. Yes or no? Now the question is, sir, how to find out the sigma P, the standard deviation of what? A 3 security portfolio. A question will arise. Is it correct? Right or not? Now, in one of the examination, they asked you to find out what the risk and return of a 3 security portfolio. So now let us see how to calculate that. Once I do that, I'll generalize into how to calculate for a n security portfolio the standard deviation of a given portfolio. Can I proceed or not? Let's start with the discussion. 3 security portfolio. Now, sigma P is equal to, no need to write anything. I'll dictate all this as a notes later. Okay. Now, this is point number 2. Sigma P is equal to, now we are having 3 securities, X, Y, Z. Proportion of X is W1. Proportion of Y is W2. Proportion of Z is what? W3. Can I proceed or not? Now, say it is W1 square sigma X square plus W2 square sigma y square plus W3 square sigma z square. Okay. Plus 2 into W1 into W2 into sigma x into sigma y into correlation of x and y. Plus 2 into W1 into W3 into sigma x into sigma z into correlation of x and z. Plus 2 into W2 into W3 into sigma y into sigma z into correlation of y and z. Take what? Square root. I get the 3 security power full standard deviation. Everybody following on. Can I proceed now? Sir, what happens to correlation of x, y, z? Don't ask here. Correlation can be always between only what? 2 items. I cannot find a correlation between 3 items. Yes or no? Yes, sir. Correlation is moving together. Yes or no? A person can marry only one person. Yes or no? I'm saying legally. Okay, polygamy not there. Okay, now. See, I can always find out correlation of x and y, y and z, x and z. That doesn't exist. A correlation between what? X1 and z is not imaginable. Are you following what I am saying? It is something out of the world. Can I proceed? Now, please. So, this is for what security? 3 security portfolio. Please don't talk. Can I proceed further? Now. Like that, one can have for 4 securities now. Yes, sir. 5 securities. Even I can have for what? 100 securities. Now, let us understand this particular formula on the previous formula, how it is got, then generalize it and then go for what? Generalization, which helps us to arrive at some conclusion. Helps arrive at what? Some conclusion, and then I'll proceed further. Can I proceed? See. Let's see for 3 security portfolio what is happening. Okay, I write like this. Okay. W1 sigma x, W2 sigma y, W3 sigma x. Please, please. Shh. W1 sigma x, W2 sigma y, W3 sigma z. Okay. Now, let's fill up the box one by one. W1 sigma x into W1 sigma x, this is what? W1 square sigma x square. Right or not? Now. W1 sigma x into W2 sigma x what? W1, W2, sigma x, sigma y. There should be linked no, by what? Correlation of x and y. Response is or no? If they are perfectly moving, it becomes what? 1. But otherwise, when I link x and y, I will always link with the help of a thread called as what? Correlation. The strength of the thread is going to be what? The strength of their co-movement. Everybody, are you following what I am saying? Now, tell me for the third, how to write here? Tell me the number. W1, W3, sigma x, sigma z, correlation of x and z. I think you are all following or not? Now, come to this. What is this here? W1, W2, sigma x, sigma y, correlation of x and y. What is this term? W2, W2, sigma y, sigma y. Correlation of y and y is what? 1. Now, here W1, W1, sigma x, sigma x, in the correlation of x and x is what? 1. That's why simply write as what? W1 square, sigma x squared. Like this. This is going to be what? W2 square, sigma y squared. Am I right or not? Now, go to the third box. What is this here? W2, W3, sigma y, sigma z, correlation of y and z. Right or not? Go to the third part. W1, W3, sigma x, sigma z, correlation of x and z. Next is what? W2, W3, sigma y, sigma z, correlation of y and z. This is what? W3 square, sigma z square. Everybody, are you all following or not? Now, we see the formula. This is called as variance box. It's called as what? A variance box. We take the square root of, they'll be getting what? The standard deviation. Yes or no? Now, so let us see. W1 square sigma x square plus W2 square sigma y square plus W3 square sigma z square. Yes or no? Now, see, plus here one W1 W2 sigma x sigma y correlation of x and y. There is another W1 W2 sigma x sigma y correlation of x and y. If I add both, I will be getting what? 2 W1 W2 sigma x sigma y correlation of x and y. Respond yes or no? Now, next. W1 W3 sigma x sigma z correlation of x and z. Yes or no? And another item is what? Here W1 W3 sigma x sigma z correlation of x and z. If I add this and this, I will be getting what? 2 W1 W3 sigma x sigma z correlation of x and z. Everybody following or not? Now, similarly, I will be having what? 2 W2 W3. This is here and this is there. No, 2 W2 W3 sigma y sigma z correlation of y and z. But in the square, I will be getting what? Standard deviation of a 3 security portfolio. Everybody, are you following or not? Please respond yes or no? Now, in this we can say there are 9 terms in this box. How many boxes are there? 9 boxes. 1, 2, 3, 4, 5, 6, 7, 8, 9. Out of the 9 terms, this, and this, I call as variance term. I call as what? Variance term. It is x with x, y with y, z with z. It is called as what? Variance term. Yes or no? And all the remaining 6 I call as what? Covariance term. What terms here? Covariance term. Respond yes or no. In other case, I will now put it generally. Now how many terms there? 9 terms in the formula. Out of the 9 terms, there are variance term and then what? Covariance term. How many variance term? How many covariance term here? Okay, I now generalize it. For a n security portfolio, how many security portfolio? N security portfolio, there will be n squared variance term. How many variance term here? Sorry, yeah, how many terms? N squared term. 2 security portfolio will be having how many terms? 4. They will be having how many boxes here? 4 boxes. 3 security will be having how many boxes? 9 boxes. 4 means what? 16 boxes and so on. So in a formula for n security, there will be how many term will be there? N squared term will be there. Yes or no? In that, how many variance term is there? N variance term and n into n minus 1 covariance term will be there. Are you following what I'm saying? There will be n variance term and then what? N into n minus 1 covariance term. Everybody following not? Now, very simple. Totally, how many variance term are there? N variance term. How many covariance term are there? N into n minus 1. The total, if you want, right, n plus, this is what? N squared minus n. It gets what? Cancelled. We have how many terms here? N squared terms in the formula. Everybody, are you following or not? For example, 2 security portfolio had or not? In 2 security portfolio, tell me how many terms will be there? 4. You'll be having how many terms here? 4 terms. Okay. Out of the 4, how many variants? How many covariants? 2 variants and 2 covariants. What 2 variants here? W1 square sigma x square, W2 square sigma y square. 2 variants term or not? What is covariance term? W1 W2 sigma x sigma y, another W1 W2 sigma x sigma y. Have what? 2 covariance terms or not? So I'm going to have totally how many terms here? 4 terms in the particular formula. Respond yes or no. 4 security portfolio. Tell me how many terms here? 16 terms. In the 16, how many variance term here? 4. How many covariance term? What is the balance here? 12. N into n minus 1. That means what? 4 into 3. Gives how many terms here? 12 terms. This is how the portfolio standard deviation will be calculated for n securities. Are you following the generalization or not? Can you respond, Mania? Yes or no? Why we are discussing this is, this has made portfolio management much more interesting. Portfolio management much more interesting. Suppose you can see stock exchanges and all, around 1,500 or 2,000 stocks are listed in New York Stock Exchange. Yes or no? In India also you have around 900 to 1,000 shares in what? Every stock is getting listed. Are you following out? So many companies shares are trading in the stock exchange. Are you following what I am saying? Now, I put a simple calculation. I invest in 100 securities. How many securities here? 100 securities. My portfolio consists of investment in shares of 100 companies. Are you following what I am saying? A very diversified investment or not? Yes. Suppose I have a 100 security portfolio. Tell me how many terms I will be having? 100 into 100. How many terms? there will be 10,000 terms in that particular calculation. Out of the 10,000 terms, there is variance and then what? Covariance. How many variance terms here? N variance. How many variance terms here? 100. How many covariance terms? 9,900. What they say is, if I add more and more and more and more securities into the portfolio, the individual risk becomes irrelevant. Understood? How they move together becomes what? More relevant. Everybody follow what I am saying? So, in portfolio theories, when you go further and further, in index models, I'll be discussing about sharp single index model, CAPM and all, they don't find out what individual security risk much more. They always relate to what the market risk, because when the portfolio becomes more and more and more diversified, the relevance of a variance term reduces, the relevance of what? Covariance term becomes what? Much more higher. And also weight becomes smaller and smaller and smaller. One security, suppose invest equal amount, yeah, one security na, the say 2 securities means my investment is 0.5, 0.5, suppose equal, yes or no? Invest in 10 securities means what? The proportion becomes what? 110. 100 means what? 100. The proportion becomes very small and the variance terms also becomes what? Very small. What is going to influence is only what? How they move together. This is a very important conclusion which CAPM, sharp single index model, uses for index models. I will find what I am saying. Index model only will let to index funds. It only left to what? Index funds, where the entire management of money has taken a great turn. So this is one of the key observations one should be knowing. Everybody following or not? So now tell me, I have N security portfolio, that risk will be having how many terms here? N square terms. In its how many variance terms? N. How many covariance terms? N into N minus 1. We have 2 or 3 securities. The individual security risk may be very important. We will have what? Number of securities. The importance of the risk of a given share reduces. The importance of what? Co-movement increases. That is why out of the 3, we have the portfolio risk influenced by what? The security risk, proportional inverse, and that is what? Co-movement. Out of the 3, which is the greatest influencing factor? Co-movement only, when the number of shares increases. When I go for more and more and more diversification, the risk is going to what? Reduce lesser and lesser and lesser because of what? Co-movement and the irrelevance of what? Individual securities risk. Is what I wanted to conclude through this particular discussion. Everybody, are you following? Now, are you following? Not now. Okay, now I had discussed how many points here? 3 points. Now, point number 1 which I discussed is 2 formulas are for sigma p. Instead of writing a correlation of x and y, I can replace by what? Covariance of x and y. Sigma x and sigma y gets cancelled in the formula. Point number 1 I discussed. Yes or no? Point number 2, I found out for a 3 security portfolio, what's the formula? Up to this, they asked in examination, they won't ask for 4 and all, it is only calculation, right or not? So 3 security portfolio, what is the formula we had? W1 square sigma x square plus W2 square sigma y square plus 2 into W1 into W2. W3 square sigma is a square plus 2 into W1 into W2 sigma x sigma y correlation of x and y plus 2 into W1 W3 sigma x sigma z correlation of x and z plus 2 into W2 W3 sigma y into sigma z correlation of y z. Take square root gives you what? The number. I just prove how that is obtained through this particular matrix. Yes or no? From this we come to the conclusion that for a n security portfolio there will be how many terms here? N square terms, n variance and n into n minus 1 covariance term is the ultimate conclusion. Due to this conclusion, when the number of securities in the portfolio keeps on increasing, the risk of the individual security becomes what? Less significant. What plays the portfolio risk determination is what? The co-movements of covariance. Because 100 security portfolio will just have what? 100 variance term. Will be having how many covariance term? 9,900 covariance term. How they move together becomes what? Much more important than how they move individually. Everybody following or not? That is why when I invest in the entire Bombay Stock Exchange shares, that is having so many shares, if I invest in what? Entire Bombay Stock Exchange shares, I am not worried about whether Infosys performs or not, or whether what TCS performs or not. I am only worried about how they move with each other what? Together. Okay. If the country as a whole does not perform, now everything will not perform. It's not. In the case, correlation becomes what? Positive. But if the country is doing good and one is capturing the market share of what? Another, I don't worry about the individual variation because I have covariance to take care of me. Are you following what I'm saying? All this will lead to a concept called as market risk. In the later stage called as beta. Everybody following or not? With this we complete the first slot called as risk return profile. Enapa purinjudha? Can I have the notes for these 3 points? Write down notes. Write down notes. Okay. Point number 1. Sigma P is equal to, let's copy this first point. Sigma P is equal to W1 square sigma x square plus W2 square sigma y square plus 2 into W1 W2 sigma x sigma y correlation of x and y square root. Correlation of x and y square root. Can I proceed? Next, sigma p is equal to W1 square sigma x square plus W2 square sigma y square plus 2W1 W2 sigma x sigma y into covariance of x and y divided by sigma x into sigma y. So what it is, replace the correlation by what? The formula of covariance of x and y divided by sigma x into sigma y. Respond yes or no. Cancel the sigma x and sigma y, which is equal to sigma p is equal to W1 square sigma x square plus W2 square sigma y square plus 2W1 W2 covariance of x and y plus 2W1 W2 covariance of x and y plus 2W1 W2 covariance of x and y. This is one point which I wanted to discuss. Can I proceed? Point number 2. What is standard deviation of? Point 2. What is standard deviation of a 3 security portfolio? What is the standard deviation of a 3 security portfolio? What is the standard deviation of a 3 security portfolio? Sigma p is equal to W1 square sigma x square plus W2 square sigma y square plus W3 square sigma z square plus 2W1 W2 sigma x sigma y rxy plus 2W1 W2 sigma x sigma y rxy plus 2W1 W3 sigma x sigma z rxz plus 2W1 W3 sigma x sigma z rxz plus 2 W2 W3 sigma y sigma z ryz plus 2 W2 W3 sigma y sigma z ryz. Take the square root whole. Take the whole square root. Everybody following or not? Next. Point number 2 or 3 or 3. Understanding the portfolio risk calculation. Point number 3. Understanding the portfolio risk calculation. Understanding the portfolio risk calculation. Can I start or not? No. Just have 9 boxes. Have a 3 by 3 matrix. columns W1 sigma x, W2 sigma y, W3 sigma z, and this is also W1 sigma x, W2 sigma y, W3 sigma z. When I multiply the share with itself, I get variance. If I multiply with what? Other, I get what? Covariance. That's the meaning. Finish copying on. Those not copy, raise your hand. Shall I proceed? 9 boxes here, 9 boxes. Invest 3 are very simple. W1 square sigma x square, W2 sigma x square, W3 sigma z square. Okay. If you copy, it will take lot of time. If you write on your own, would have completed quickly. Correct, Abba? Finish copying, huh? Write down. From the above matrix, for a 3 security portfolio, we can see that there exists. For a 3 security portfolio, we can see that there exists. There exists how many terms? 9 terms. For a 3 security portfolio, there exists 9 terms. Branch it into 2. There exists 9 terms. Branch it into 2. First branch, variance terms is equal to 3. Variance term is equal to 3. Next is what? Covariance term is equal to 6. Variance term is equal to 3. Covariance term is equal to 6. Continue. From this we can generalize by saying that a n security portfolio will have, you can generalize by saying that a n security portfolio will have how many terms? N square terms. N security portfolio will have n square terms. Write n square. Branch it into 2. Write n square. Branch it into 2. First is what? Variance. Second is covariance. How many variance terms will be there? N variance. How many covariance term? N into n minus 1. N variance term, n into n minus 1 covariance terms. I hope you are not following or not. Now, write down, check. N variance term plus. What is n into n minus 1? N squared minus n. N plus n squared minus n. N gets cancelled. How many terms here? N squared terms. N squared terms. Everybody, are you comfortable or not? Now, last point. 3 or 4? Point number 4. Suppose we construct a portfolio with. Suppose we construct a portfolio with 100 securities. So we have seen all of the Fortune 500, S&P 100, we are having so many, say, good portfolios or not. Suppose we portfolio with what? With 100 securities. Suppose we construct a portfolio with 100 securities. It will have 100 squared is equal to, it will have 100 squared is equal to how many terms? 10,000 terms. It will have 100 squared is equal to 10,000 terms. Branch that 10,000 into 2, branch that 10,000 into 2, variance, covariance. Variance, covariance. How many variance term? N is equal to 100. Variance right, N is equal to 100. Covariance right, N into N minus 1 is equal to 100 into 99. N into N minus 1 is equal to 100 into 99. How many terms? 9,900 terms. 9,900 terms. Can I proceed? Write down. Continue writing. As a number of securities in the portfolio increases, as a number of securities in the portfolio increases, the relevance of individual securities risk. The relevance of individual securities risk and the proportion, the relevance of individual securities risk and proportion slowly diminishes. The relevance of individual securities risk and proportion slowly diminishes. And the portfolio risk will be mainly influenced by, and the portfolio risk will be mainly influenced by covariance terms. And the portfolio risk will be mainly influenced by covariance terms. Will be mainly influenced by the covariance terms. Everybody, are you comfortable or not with this? We completed slot 1 in this chapter, portfolio management, called as what? Risk return profile. Everybody, are you following or not? Those are far left. Can I proceed or not? Next. Give the heading Markowitz portfolio theory. Question number 7. I'll do the end of the chapter as a miscellaneous sum. So we'll just leave question number 7. Question number 8 onwards, the Markowitz starts. Okay. Okay. Now, Stop talking. See, these theories, Markowitz, Sharp, CAPM, and then later arbitrage pricing theory. Don't talk, please. All these theories greatly changed the way the people started investing money in the stock market. They gave some theoretical background in which money can be properly invested. That is why for all these works, Nobel Prize has been granted under the heading economics. The economics Nobel are granted to all these persons, Markowitz, Sharp, and then Ross we call for APT. All these theories have changed the way the mankind invested money, and it changed the way how the economies performed, and also lifted the way in which the standard of living improved. Always any Nobel will be given only to persons who change drastically how the mankind lives. I will follow what I am saying. And this has totally changed after 1950s when Markowitz first published his theory. The way in which they started looking at the investment, started making investment drastically changed. Today all the stock exchanges are mainly following CAPM, that is a capital asset pricing model for making their investments. But CAPM couldn't have come without what? The background of Markowitz theory. Similarly, APT is now gaining momentum in the investment sphere, and from there only so many new instruments like index fund, hedge funds, everything came into thing. Okay, so this is a very important area we are going to discuss. In examination, they may ask questions from Markowitz or Sharp or what? CAPM or APT. But the challenge is, from which theory the question has been asked, people don't understand. Study material, they don't bifurcate and give something they have written. We don't know what is being discussed, but one should be able to have a full conceptual knowledge about what these theories are saying, how one theory led to what other, and how the investments are changing. So the conceptual understanding is very important for even in solving an examination question where you have to identify the correct theory and apply the correct formula for the calculation, because all questions may seem to be what? Similar under all the theories. They are all discussing about the same thing, investment determination, right or not? But how it should be answered is somewhat different. You have a very structured approach to all these four theories: Markowitz, Sharp, APT, and then capital asset pricing model. Okay, now first we start with the Markowitz theory. We will discuss this with the help of a problem, question number 8. At the end of this question number 8, we should be able to know the following things. What is that we are going to learn at the end of this question number 8? We should have learned something called as what is an efficiency frontier, or what is an efficient frontier. Number 2, what is a utility curve? What is an efficient portfolio? How one can combine a risk-free asset with a efficient portfolio to just develop a line called as capital market line. How the capital market line can be extended to become a levered capital market line. These are all the issues we'll try to address in this area called as Markowitz theory. It's a single discussion. It's not a single discussion covering all these points. We will run to 2 classes. You're already following order. So we'll be dealing with this theory in how many classes? 2 classes. At the end of this theory, tell me what you should be learning. It is in the slide. What should be learning? What do you mean by efficiency frontier? What is a utility curve? How the efficiency frontier utility curve is used to find out what? Efficient portfolio. And how to find a portfolio with a risk-free asset and efficient portfolio. And next is how we can form a capital market line, and how we can become a levered capital market line, are all the issues we'll be discussing in this area called as Markowitz theory. Okay. When I do question number 8 itself, I'll go to question number 9. That is, when I complete efficiency frontier, am I going to do what? Question number 9, it speaks about what? Efficiency frontier. Like that, when I complete question number 8, last 8, I'll go into question number 10. 8, 9, 10. These 3 problems completely covers all the issues regarding the Markowitz portfolio theory. Can we start or not? So, in between question number 8, I'll go to other sum and come back, because up to that discussion, that problem may be easily able to be solved. Is a pattern in which I'll be doing this discussion. Can we start or not? Now, question number 8 is an example which I given as a question. Okay, from this we are starting to learn how Markowitz recommends people to make investments, how investment managers or person are doing equity research should be making investments in different securities, determining based on the risk return profile. Can I start or not? Now, in all this, we have an assumption. We know what is the return of a security. Markowitz assume what is the return of a security? Expected return. What is the expected return? Either average return, simple average or weighted average. What is the risk of the security? In standard deviation. Okay, it can be with probability or without probability, one know how to calculate. And when I have portfolio of security, what is the expected return? Weighted average return, where the weights are the proportion. And what is the portfolio risk here? Sigma P is equal to those calculations. Everybody has to know all these calculations are presumed to be understood before you move into the portfolio Markowitz theory. Everybody, can we start or not? From there, we develop the theory further. Can I proceed? Because I cannot go into these numbers again and again. If I go for a macro level discussion, if I come to micro once again, what happens? You'll get confused, the track will be lost. Are you following or not? Now, so that is why I did the risk return profile first. Are you all very much clear about the first stage or not? That is clear alone, not important. You all remember fully or not? Anytime I recollect, one should be able to what? Understand it quickly. Can I start or not? Let's start with the Markowitz theory. Now, particulars. Security A, security B. We understand with 2 securities. If I can understand a theory with 2 securities, we can understand with what? 100 securities also. Because with 100, Markowitz will not be able to explain him. Yes or no? Hence he took what? 2 securities. The similar example is given by Markowitz to explain his theory. Can I start or not? Now, there are 2 securities, security A and security B. Standard deviation 20, 40. Just for me confirmation. How they would calculate this 20? Sigma A squared. How they would have calculated that? Sigma A minus A bar the whole square divided by what? N square root. Correct? And what is this here? Sigma B. How to define sigma B? Sigma B minus B bar the whole square divided by a square root. The probability is simply what? Sigma P into A minus A bar the whole square. Sigma P into B minus B bar the whole square. Now, similarly, they given you the expected return. That means what? Average return of the individual securities. Can I proceed up? Now, the correlation between the 2 securities is minus 0.2. How they would have calculated these numbers? Covariance of A and B divided by sigma A into sigma B, where the covariance is what? Sigma A minus A bar into B minus B bar divided by N, or sigma P into A minus A bar into B minus B bar. All these data numbers, we know how to calculate. This itself should be calculated before you go to Markowitz normally. Respond, yes or no? Next step. Calculate the return and risk of the portfolio for different combinations of A and B, and explain with the help of that data arrived the concept of efficient frontier, utility curve, efficient portfolio, portfolio with risk-free asset, and efficient portfolio, and the capital market line are all the issues I want to discuss in this particular Markowitz. Can we start or not? Now, I have done some basic calculation, given you the conclusions. From there we can start our discussions. Okay, now. Okay, now I am going to have 6 portfolios. How many portfolios? All 6 portfolios consist of the same 2 securities A and B. I am going to have how many portfolios? 6. I just take sample 6 portfolios. All 6 consist of how many securities? 2 securities. Name 2 securities. But the only difference is in one portfolio we are having 90% A or 10% B. Another we are having what? 10% A, 90% B. That will be changing only the proportions, but the securities are what? Same. The portfolio differs because of what? The weights or proportions. Everybody, can I proceed or not? Now, I have 6 portfolios. Portfolio 1 consists fully of what? A and nothing of B. Understood? Isn't it correct? Now, portfolio 2 where I put 90% of my wealth in what? A and then 10% in what? B. Portfolio 3 where I put 75.9% of my wealth in what? A and then 24.1% of wealth in what? B. This number is very, very unique. There's a formula for calculating this number. I'll discuss at appropriate time. Everybody follow or not? Assume that number, that's all. Portfolio 3 consists of what? 75.9% of A and 24.1% invest in what? B. Portfolio 4 consists of 50% A, 50% B. Portfolio 5 consists of 25% in A, 75% in B. And guess what is portfolio 6? Nothing in A and fully in B. I just construct 6 portfolios at different proportions. Everybody, yes or no? Others are all just the number that came to my mind. But this number is a very, very unique number, a very important number. Above that, there is a formula we discuss in the next stage. Everybody following what I am saying? So these are the 6 portfolios. Are you following not? No. These 6 portfolios should have a return or not? These 6 portfolios should be having a risk or not? What is the return of a portfolio? Weighted average return. What is the risk of the portfolio? Sigma P calculation. Ennappa, right or not? Now, we know how to calculate the sigma P, W1 square sigma A square plus W2 square sigma B square plus 2 into W1 into W2 into sigma B into correlation of A and B. Like that I can find out the risk of the portfolio or not. So now, that work I did not give to you, I have done myself. So RP means what? Return of portfolio. Sigma P means what? Risk of portfolio. For all the 6 portfolio, this is my risk and return. I have just calculated. Everybody following? Please copy this first before you go for the next stage of discussion. Question number 8. Finish copying, huh? You are not calculating, na? That's copying, la, copy fast. Only 6 numbers, 6 portfolios. Yes, Iba. Those not copy, raise your hand. Shall I proceed? Please. யாரு போகும்போது டிஸ்ட்ரிபியூட் பண்ணிவிடுவோம் போகும்போது எல்லாம் கொடுத்துடும் ப்ளீஸ் finish copying now Can I start or not? No. Before I start, I want to confirm myself whether I understood the numbers. I'll confirm and then start. Start day should not be bad, right or not? No. See. I invest only in security A. I invest only in what? Security A. What is the return of that security? Look at the verb. What is the return of the security? 12%. What is the rest of that security? 20%. That is a standard deviation, right or not? So, it is not a portfolio. Single security investment. Yes or no? No. Come to the last point. If I invest the money only in what? Security B. Portfolio 6. What is the return of that security? 20%. What is the risk of that security? 40%. In between I have combination, right or not? Now, only one you tell me. For example, portfolio 2. What is portfolio 2? 90% A and 10% B. What is portfolio 2? 90% A and 10% B. I may be repetitive, still let us see what is the return of that portfolio. Please, you need not copy, just for your confirmation. Security, and then what? Proportion. Third is what? Return. And fourth is what? Weighted return. Please, everybody participate with me. Yes or no? Now, I am doing for which portfolio? Portfolio number 2. Tell me, what are two securities? A and B. What are the proportion? 0.9, 0.10. What A gives? 12. What B gives? 20. 12 into 0.9. 10.8. 20 into 0.9 gives how much? 2. What is the portfolio? 12. RP, written up portfolio is equal to 12.8. Having a slide or not? Yes. Similarly, I have to find out sigma P, no? Tell me what is sigma P? W1 square. What is W1 square? 0.9 square into what is sigma A square? What is sigma A square? 20 square. Plus W2 square. Point into what is sigma B square? 40 square. Plus 2 into W1 is what? 0.9 into 0.1 into 20 into 40 into, for the correlation, minus 0.20. This will become minus later while calculating, yes or no? If you put what? Square root, you can believe me, I will be getting 17.64%. I will be getting 17.64%. This is going to be the sigma P for the second portfolio. Everybody, yes or no? Like that, I found out the return risk for the third, fourth, fifth, and then what? Sixth portfolio. Respond. Can we start or not? Now, let's start with our discussion now. See, security A, if you look at it, is a low return, low risk security. Accepted? Now, good morning, friends. I am going to start my discussion. This is going to be the observation helpful for another one class fully. Please be wake up. Can I start or not? Now, security A. Let's take share A. Security A is having how much return? How much percent risk? 20. Security B is having how much return? 20%. What the risk? 40. Now tell me, security A is having high return or low return? High return or low return? Low. Security A is having high return or low return? Tell me. Low return. He is having high risk or low risk? Low risk. So the nature of the security is, it is a low risk, low return security. Yes or no? Now, security B is what? High return, high risk security. Observation now. Are you following or not? Let's go to the next one. Now, what happens is, my first portfolio consists only of security A. So my return is lowest. How much it is? 12%. And risk is also lowest. How much it is? 20%. Point number 1. Accept or not? Now, in that, I am going to inject B. I am going to want to inject B into my portfolio. Okay. A portfolio consists of A. What I am going to do is, I am going to reduce my A proportion. I am going to inject what? B. That means, in a low risk, low return portfolio, I am injecting what? A high risk, high return security. Respond yes or no? when you do that particular process in a low return portfolio, if I inject what? A high return security, return should increase or not? Yes. That is why 12% became what? 12.8, because my portfolio not only consists of a 12% return security, is also having what? 20% return security. When I inject a high return security into the portfolio, the return also obviously increases. Enna paritana? Enna purinjudha? Now, in a portfolio having low risk, if I inject a high risk security, in a low risk portfolio, when I inject what? High risk security, the portfolio should increase or not? But to our surprise, the risk has decreased. Everybody, are you following? Huh? Now, very simple. Look at what is happening in the process here. A is a security having low risk, low return. Yes or no? With that, if I combine B, what is B? High risk, high return. In a low risk, low return portfolio, if I inject a security with one, high risk, high return, the return should increase, the risk also should increase. But to our surprise or to our happiness also, the return has increased, but the risk has what? Decreased. Because the 12% became what? 12.8. By injecting B, the 12% became what? 12.8. Because high return security boosted my portfolio return. Yes or no? But by injecting B, high risk security, we expect the risk also to what? Increase. But the risk has what? Decreased to 17.64. Yes or no? Why? The question arises due to what? Correlation. Due to what? Negative correlation. Having a minus point due to what? Correlation. It happens as technical answer. The logical answer is due to diversification. Diversification reduces what? Risk. So even though I add a high risk, high return security, the return I have managed to increase, but the risk I have managed to what? Decrease. It's very great. Are you following what I'm saying? Now, I became very happy. Super. Injecting B is what? Very great. I further injected what? B. From 10%, I increased the proportion to what? 24.1%. And A became 75.9 in the portfolio. And B became how much? 24.1. So is my expectation satisfied? Yes. The return what? Further increase. The risk what? Further increase. Decreases. Respond yes or no? Then I thought, putting B more and more increases return, decreases what? Risk. So what I did? I further injected what? B. I made 50A and what? 50B. The return increase or not? Yes. What happened to risk? Risk also begins to increase. Respond yes or no? That means after some time, there is a saturation point where the benefit of diversification gets what? Exhausted and the return begins to increase. Everybody following what I am saying? The second observation we made from this particular data. Are you following the observation? Can I proceed further? Now, this can be visualized with the help of the following diagram. Okay, see here. So, the x-axis is what? Risk. And y-axis is what? Return. Can I proceed? Now, look at this. These are the 6 portfolios. These are what? The 6 portfolios. Okay. Portfolio 1 is having a risk as well as return. In your notebook, what is the risk? What is the return here? Risk is what? For the 20% risk, the return is what? 12%. Accepted? Now, portfolio 2, the return increased. But the risk increase or decrease? Okay. When the return increases, I'll go up. This is return. My return become 100%, go upwards. Yes or no? When the return increases, my point moves upwards. Okay. When the return decreases, my point moves what? Downwards. When risk increases, I go right. When risk decreases, come what? Left. Yes or no? Now, see, this curve is moving upwards due to introduction of what? B, because B increases my return. But the curve does not go rightwards, it moves what? Leftward, because the return increases as well as what? The risk also decreases. Everybody following or not? Now, okay. I got very much happy. I injected what? More B. If you like something, you eat more and more. Yes or no? I injected what? More B. What happens here? Return further increases. Yes. In portfolio 3, the return further increases. I am moving right or leftwards. I move further leftward. The risk what? Further decreases. Yes or no? I became very much happy. I injected what? More B. What happens here? The return increase, but the risk also what? Begin to increase. The curve begins to make a U-turn. Are you following what I am saying? This is a Markowitz called as minimum variance portfolio. What portfolio? Minimum variance portfolio. This observation, everybody able to follow or not? Okay. Now, Let us have some more discussion linked to the risk return profile discussion and then go to the next stage of Markovitch discussion. Can I proceed? Now, see, what happens is, by constructing a portfolio, I manage to move leftward. I manage to move what? Leftward. Always go what? Upwards. It is not. But the leftward movement will not be permanent. The leftward is going to make what? A right turn at some point of time. Yes or no? The point where I make a right turn is called as what? The minimum variance portfolio. From that I move right as well as what? Top. The return also increases. The risk also increases. Is observation one more from here? Yes or no? Now, this is the curve when the correlation is minus 0.2. The correlation is what? Minus 0.2. There are two extreme correlations, minus 1, plus 1. In the right order? Now, when the correlation is minus 1, when the correlation is what? Minus 1, the equation is W1 sigma x minus W2 sigma y. Yes or no? Yes, sir. When the correlation is plus 1, the equation is W1 sigma x and W2 sigma y. Yes or no? At minus 1 plus 1 correlation, square root goes, square and all go, it becomes a linear equation. Yes or no? Till correlation is not minus 1 or plus 1, it is not a linear, it is a curve. Yes or no? In a square root means what? To the power 1 by 2, we have W1 square, sigma x square, having squared as well as what? A square root. The relationship is a curve. Yes or no? Once to the power comes W1 power 1, sigma x power 1, plus W2 power say 1, sigma y power 1. Yes or no? Now, when the correlation is minus 1 or plus 1, the square root vanishes, the square vanishes, the equation becomes what? A linear. The risk equation becomes linear between proportion. Yes or no? In that case, linear it will be a curve, a straight line. Yes or no? So what we understand is, when r is equal to minus 1, this is how it looks like. When r is equal to plus 1, this is how it looks like. Everybody following? Huh? Now I am going to explain this further. Okay, see, when r is equal to plus 1, correlation is what? Plus 1. Will diversification reduce risk or will not reduce risk? Will not reduce risk. That is why when you inject more and more and B, the return increases, the risk also what? Increases. There is no leftward movement because there is no risk reduction of what? Diversification when R is equal to plus 1. This point, are you following or not? When correlation is positive, through combination, can I reduce the risk? Cannot reduce the risk? Cannot reduce the risk. I have a low return, low risk security A. If I inject what? High risk, high return security B, and correlation is what? Plus 1. Putting B will increase the return as well as what? Increase the risk because I don't get any benefit through diversification because R is equal to plus 1. Right or not? So there is no leftward movement. It becomes what? Right. That too not a curve. It is only what? Straight line. Now the equation becomes a linear equation. Point number 1. Accepted? Now, when R is equal to minus 1, the risk reduction is more than this curve. What happens is, when I inject B more and more and B, I am going to reduce what? Risk as well as what? Return increases. But note that I can even reduce my risk to 0. Can even reduce my risk to what? 0. Through an optimum portfolio proportion. Are you all following what I am saying? So, when the correlation is not equal to minus 1, the risk will never touch y-axis. It will go up to some and then what makes a right turn? The right turn happens in minus 1 at what? Y-axis, because when R is minus 1, risk can even be reduced to what? 0. We saw proportion of A is equal to what? Sigma B by sigma A plus sigma B, and proportion of B is equal to what? Sigma A by sigma A plus sigma B. Are you all following what I am saying? So, minimum variance portfolio, that is what? Portfolio with the lowest standard deviation. Minimum variance portfolio will have 0 variance when correlation is what? Minus 1. And minimum variance portfolio will not have 0 variance. It will be having what? Some variance when the correlation is not equal to what? Minus 1. Also can be observed from this particular diagram. Everybody following? Yes, sir. Yes or no? Now, I will put the formula and then come back to this diagram once again. Okay, sir. When correlation is minus 1, I know when it takes a right turn. At what? 0. This proportion you can find out or not? Yes. What the proportion here? Sigma B by sigma A plus sigma B, and sigma A by what? Sigma A plus sigma B. But the question is, how shall we found out this number exactly as what? 75.9 and 24.1. Question arises no? When I inject B more and more and more, I am experiencing increase in return and reduction in what? Risk. After some time, it makes a U-turn or not. That point of U-turn, I perfectly found out to be what? 75.9, then what? 24.1. How have we found out that point 75.9 and 24.1? Question arises, no. For this, there's a formula. I'll derive the formula at the end of the discussion later. I don't want to go into derivation now to just sidetrack the issue. There's a formula. It can have also what? Derivation. The formula is as follows. Now, if I have a correlation as -1, all of you have the correlation of what? -1, then the line will move leftward up to what? 0. And then makes what? Right hand. The 0th point will be having a proportion or not? Tell me what a proportion of A that? Sigma B by sigma A plus sigma B. What the proportion of B? Sigma A by sigma A plus sigma B. That understand or not? No. The correlation is not -1, but it does 0. But it will go leftwards and make what? Right turn. The point where it turns, that profile will be having some proportion or not. How to find a proportion of A and proportion of B? As follows. Proportion of A is equal to sigma B squared minus sigma A into sigma B into correlation of A and B divided by sigma A squared plus sigma B squared minus 2 into sigma B into correlation of A and B. We'll derive this formula, simple differential calculus only, but this is a formula for that particular proportion of A. Now, can you guess what is proportion of B? Sigma A square minus sigma A sigma B correlation of A and B divided by sigma A square plus sigma B square minus 2 into sigma B into correlation of A and B. Don't ask the logic of the formula straight away. I cannot tell the logic straight away. I can find out what? Derivation. Very simple. Yeah. Sigma P is the equation of square root. I have number or not. Find out the first derivative of the sigma and equate it to what? 0. I get maximum minimum. For any function, you find out the dy by dx for that function and equate it to what? 0. I'll be getting what? Maximum or minimum value. So no, it is a maximum minimum depends on the second derivative. If the second derivative is positive, becomes what? Maximum. Negative becomes what? Minimum. Using that, the formula can be derived. Forget about the derivation. This is a formula. In one of the examinations, they ask you to find out this proportion using what? This particular formula. Everybody following not? But if you read books and study material, we don't know why sometimes they're using this formula, sometimes using what, some other formula and so on. This is the background. When correlation is -1, the PA, PB formula is what? A linear formula. What is linear formula? Sigma A by sigma A plus sigma B or sigma B by sigma A plus sigma B. When the correlation is not -1, how to find out the minimum variance portfolio? The minimum variance portfolio should be found out using this particular formula. When correlation is +1, what is the minimum variance portfolio? When correlation is +1, what is the minimum variance portfolio? Security A, that's all, it's or no. When index B, return also increases, risk also increases. Everybody, are you following what I am saying? So this is the first stage of observation one has made from what? Markov weights. We are not a start on Markov weights, we are only observing what? The data given by the sum. Are you following what I am saying? Now, one last conclusion before you go for the notes in this regard after copying the slides. Okay, first of all, point number 1. I have two securities, A and B. Everybody participate. A is what? A is what? Low return, low risk. I am going to ask 100 times. How to repeat what? 100 times. Can I say A is what? Low risk, low return. B is what? With A, if I inject B, what increases? Return increases. Will risk increase? The risk has in fact what? Decrease. Why a high risk security inside a portfolio decreasing the risk? Because of the correlation coefficient or diversification. So if I keep on injecting B more and more and more, the return increases, the risk decreases. That is a curve more upwards as well as what? Leftward. But is it going to be permanent leftward momentum? No. After something the curve makes what? Right turn. At that time the return increases, the risk also increases. The leftmost point in the curve we call as what? Minimum variance portfolio. If the correlation is -1, it is not the curve, it becomes what? Straight line. The leftmost point is called as what? Minimum variance portfolio having a standard deviation of 0. In this case, minimum variance portfolio cannot have what? 0 sigma. Will have a lower sigma. How much is 16.27? With this mix, I cannot reduce risk beyond what? 16.27. One should be understanding it. Yes or no? Now, in case of A and B, R is equal to -1. What is the formula for minimum variance portfolio? Proportion of A is equal to sigma B by sigma A by sigma A plus sigma B. Proportion of B is equal to what? Sigma A plus sigma B. When the correlation is not -1, it is other than -1, then also I can find out the minimum variance portfolio. What is proportion of A? Tell me. sigma B square minus sigma A sigma B correlation of A and B divided by sigma A square plus sigma B square minus 2 sigma A sigma B correlation of A and B. Yes or no? Now, same we have to find out for proportion of B also. When correlation is plus 1, will I move leftwards up? No. I straight away move only what? Rightward. So, low risk, low security will be what? The minimum variance. We inject the high risk, high return security, the risk is going to obviously what? Increasing the return also. No benefit due to diversification. Is the first stage discussion of this Markowitz data given. Everybody, are you following? Huh? So, can I proceed further? Now, what you can do is, first write down notes. So, it is going to be a stage by stage discussion. So, we are going to consolidate every step before you go for the next one. Write down notes. Point number 1. Security A is low return, low risk security. Security A is low return, low risk security. Security A is low return, low risk security. And security B is fill in the blanks, high return, high risk security. Point number 2. By injecting security B, injecting means what? Introducing. Okay, by injecting security B into the portfolio comprising of security A, by injecting security B into the portfolio consisting of security A, by injecting security B into the portfolio consisting of security A, the return increases. You can understand the reason why return increases. Yeah? B is what? High return, the return increases. But instead of increase in risk, the risk has in fact decreased. But instead of increase in risk, the risk has in fact decreased. Because of the risk reduction effect of diversification. Because of the risk reduction effect of diversification. Or technically due to what? The negative 0.2 correlation. Point number 2 or 3 or 3. Okay. Point number 3. This is a reason why in the diagram below, we'll draw it later. Okay. The reason why in the diagram below, the curve moves what? Upwards. The curve moves upwards and what? Leftwards. Because the return increases and the risk decreases. Point number 3 or 4? 4. This diversification benefit, point number 4, this diversification benefit is not permanent. After some time, in bracket portfolio 3, after some time, in bracket write portfolio 3, bracket close, the return increases, as well as, fill up the blank, as well as what? Risk increases. The return increases as well as the risk increases. The return increases as well as the risk increases. That is, what are you saying? What do you want to say? I declare correctly. What I said is, the reduction risk is not what? Permanent. Yes or no? After portfolio 3, declare panninappa. What happens here? The return increases as well as what? The risk increases. Enna right or not? I did not say portfolio 3. I said what? After portfolio 3. Enna thungadaya? Yes or no? No. Next. That is, the curve begins to move upwards. That is, the curve begins to move upwards and what? Rightwards. The curve begins to move upwards and rightwards. The curve begins to move upwards and rightwards. Can I proceed or not? Next. Point number 4 or 5? 5. This portfolio 3 is the portfolio consisting of A and B. This portfolio 3 is a portfolio consisting of A and B. Is a portfolio consisting of A and B that has what? Lowest risk. This portfolio 3 is a portfolio consisting of A and B that has the lowest risk. And the proportion is calculated. As follows. Is a portfolio consisting of A and B has the lowest risk, and the proportion is calculated as follows. Everybody, can I proceed up? Write down first. Copy this. Same point you continue. Proportion of A is equal to, please copy the formula. Proportion of A is equal to, this is the formula. Finish copying. Stop talking. Finish copying or not? Can I proceed? Now. Before that, tell me what the formula. Proportion of A is equal to what? Don't look at the notebook. Look at me whether you like it or not. What the formula? Sigma B squared minus sigma A into sigma B into correlation of A and B divided by sigma A squared plus sigma B squared minus 2 into sigma A into sigma B into correlation of A and B. Opposite for proportion of B. Can I proceed or not? Now, let's substitute the numbers. Proportion of A is equal to, substitute the numbers. Okay. 40 squared is what? Sigma B squared. In a standardization of B, 40. Isn't it correct? 40 squared minus sigma A, sigma B is 20 into 40 into correlation is minus 0.2. When you just simplify, the minus into minus become plus. Then when you calculate 40 squared minus 20 into 40 into minus 0.2, this minus into becomes what? Plus. Answer will be 40 squared plus 20 into 40 into 0.2. Isn't it correct? Divided by 20 squared plus 40 squared minus 2 into 20 into 40 into minus 0.2 Number also becomes what? Plus. When you just multiply two negatives. You get 0.759, believe my number. And second proportion of B also, same way you just copy it. Only thing is 40 square replaced by 20 square. The remaining numbers are all same. Finish copying, huh? Now, point number 4 or 5, what I dictated? Point number? Please, stop talking. One number solliya, what I last dictated? Now I have to dictate point number 6, write down. Point number 6. If R is equal to minus 1, before that, sorry, we copied up to that number or not, write down. This portfolio is called, one line you add it here, in the point number 5. This portfolio is called minimum variance portfolio. This portfolio is called minimum variance portfolio. Now, in point 5, I am discussing about portfolio 3. This portfolio is called minimum variance portfolio. This portfolio is called minimum variance portfolio. Is called minimum variance portfolio. Now, point number 6. If R is equal to minus 1, if R is equal to minus 1, through a combination of A and B, the risk can even be made to 0. Through combination of A and B, the risk can even be made to 0. The risk can even be made to 0. Already we discussed such proportion to be, proportion of A is equal to sigma B by sigma A plus sigma B. Proportion of A is equal to sigma B by sigma A plus sigma B. And proportion of B is equal to sigma A by sigma A plus sigma B. Sigma A by sigma A plus sigma B. Continue. That is, the curve becomes a straight line. That is, the curve becomes a straight line. Due to linearity of sigma P. The curve becomes straight line due to linearity of sigma P. Why you say sigma P is linear? W1 sigma x minus W2 sigma y. All are power to 1. Yes or no? Due to linearity of sigma P, and the straight line touches y-axis, before it starts moving on right. The straight line touches y-axis before it starts moving towards right. It touches y-axis before it starts moving towards right. Everybody following or not? Now, last point. Point number 8 or 9 or 10 or 6 or 7 or? Your number, point number 7, not a section number. Can I say? Point 7. If correlation is plus 1, there is no risk reduction. If correlation is plus 1, there is no risk reduction due to diversification. If correlation is plus 1, there is no risk reduction due to diversification. Hence, Hence, there is no leftward movement. Hence, there is no leftward movement. Hence, there is no leftward movement. Are you following order? I don't go left and take right. I always move only towards what? Right. Hence, there is no leftward movement. Everybody following or not? Now, please copy this diagram quickly. Copy this diagram quickly. Now, I'll tell you what to do. Don't put point first. Put a curve like this and then plot 6 points. Ensure that the third point is in what? The tip of the parabola. Are you following what I am saying? So draw like this. First a curve and then plot the points, and then the leftmost point can be called as point number 3. Then this is r is equal to point minus 0.2, one diagram. Other diagram in the same graph I have drawn, r is equal to minus 1, another is r is equal to plus 1. Please draw it quickly. Finish copying, huh? Those not copy, raise your hand. So don't pack your bags. Have still solidly 15 minutes left. Okay. I have to make one more conclusion and then finalize it. Otherwise, it will be left hanging. Okay, please. I have to complete up to a stage here. Don't disturb me, please. Finish copying on now. Whether you copy or not, I'll continue up to what I want. Okay, it is in your interest. Copy fast. Those not copy, raise your hand. Nothing there. Put your curve like this, one straight line, another straight line. That's all. Yeah, Ravi Verma drawing you are making. Can I proceed now? Can I proceed now? See, what Markowitz says is that, please. Shh. Now. Shall I proceed? Don't talk, please. See. You have 6 investment options. Only options here. In this case, 6 investment options consisting of what? Different proportion of A and B. Right or not? Now, one thing is sure. Option 1 is inferior to option 2. Stop talking, please. Option 1 is inferior to what? Option 2, because option 2 gives a higher return for a lower risk. Yes or no? Option 2 is inferior to what? Option 3, because option 3 gives what? Higher return for a much more lower risk. Yes or no? Option 4 is what? Option 4 is not inferior, not superior, because from 3 onwards, 3 gives what? Lowest risk for some return. 4 gives what? More return, more risk. 5 gives what? Much more return, much more risk, and so on. So what Markowitz says that 1 and 2 portfolio will be called as inefficient portfolio. Called as what portfolio? Inefficient portfolio. And 3, 4 and 5 is called as what? Efficient portfolio. Everybody, are you following or not? Now, please, don't talk. What is an efficient portfolio? Let us define it. Let us define what is an efficient portfolio. Listening, huh? Efficient portfolio is a portfolio where there exists no other portfolio which gives higher return for a lower risk, or higher return for a same risk, or the same return for a lower risk. கேட்டியப்பா? Now, again repeat. If you concentrate, you can understand. Otherwise, no point in continuing. This is wrong here. You don't pressurize me after 9 o'clock. You don't come here by 6:15. Gadaba. You don't have right to go even by 9:15. Not at 9 o'clock at least. Can I proceed? No. See, always this is happening. Every class after 9, I become tensed here. Okay. No. Now you are slowly putting pressure on me. Undue influence. I'm making okay to make me leave the class. Okay. No. I am not going to get influenced. You are going to sit, listen. Unless you understand, I will never leave. I'll lock the door, please. Listen. Last point here. Last point. Important. I have to continue this in the next class. Now, please listen. First of all, 1, 2 are inefficient compared to 3. 3 is giving more return for what? Low risk. Markowitz says you should put your money only in efficient portfolios. No fool invest in what? Inefficient portfolios. So no. Now he said, what is an efficient portfolio? Very simple. A portfolio is efficient. A portfolio is what? Efficient. If there is no other portfolio, if there is what? No other portfolio which is going to give me more return for the same risk. More return for a lower risk. Yes or no? Or same return for a lower risk. I will find not. Now, for example, there's a portfolio A. If B gives more return for a lower risk, then A is inferior. If B gives more return for the same risk also, B is inferior. Yes or no? Or if B gives the same return as A, but for what? Lower risk also, A is inferior. Yes or no? For A not to be inferior, there should be no other B that gives what? More risk for a low, more return for a low risk, more return for a same risk, or same return for a low risk. Like that, if a portfolio exists, I call that as what? Efficient portfolio. Respond yes or no? The last diagram here is, this is the efficient portfolio. So Markowitz says, in our diagram, I'll weed out 1 and 2. I'll draw only what? 3, 4, 5 and 6. In this point, only I have to make what? Investment. I'll not invest in what? 1 and 2. Everybody following not? Now. So this curve is there or not? This curve only I call as what? Efficiency frontier. This curve is called as what? Efficiency frontier. It starts with a minimum variance portfolio and start like an umbrella moves what? Upward. They call it as a broken egg curve. What is that? Yeah? Broken egg shaped curve. You have a broken egg. How it looks like? Yeah. In a road la pada okay. It looks like, as well as or not, like a broken egg, the curve what looks like. And this curve, he gives a name called as what? Efficiency frontier. We call it as what? Efficiency frontier. And all my investment should be only on those portfolios lying on the efficiency frontier, not below it, is what Markowitz says. We'll see more about this efficiency frontier in the next class with some problems. Are you following or not? So we can have the notes for this in the next class with further discussion. In a hurry to leave. Please be here on time in the next class. Okay.
Thank you friends. OMSAI Bhojanapalli.